You have two types of analysts constantly arguing with each other. On one side, the fundamental purists who say that charts are voodoo magic and that you should only care about a company's intrinsic value. On the other side, the technical traders who claim that all fundamental information is already baked into the price. So why bother with earnings reports? But what if I told you that both sides are only half right? Relying solely on fundamentals can leave you buying a wonderful company at the exact wrong time, watching it fall 50% before it eventually recovers, and relying solely on charts can have you trading empty shells of companies that have great patterns but terrible businesses. The most powerful approach is to become a complete investor, one who uses fundamentals to find the diamond and then uses technicals to know when to pick it up. This is about building a bulletproof process where one method validates the other. In this guide, we're going to build a bridge between these two worlds. You'll learn a step-by-step process for using fundamental analysis as your quality filter and technical analysis as your timing mechanism, creating what I call the slingshot method for high-probability investing. The first step is always fundamental analysis, and its job is to answer one question: is this a company worth owning? This is your quality control department. You're looking for a business with a durable competitive advantage, a strong balance sheet with manageable debt, consistent revenue and earnings growth, and competent management. You're digging into the financial statements, the income statement, balance sheet, and cash flow statement to assess its health. You're calculating valuation metrics like the price-to-earnings ratio, price-to-sales ratio, and comparing them to the company's own history and its industry peers. The goal here is to create a watch list of high-quality companies. You are determining the what. For instance, through your research, you might conclude that company XYZ, with its strong brand loyalty, rising profit margins, and solid cash flow, is a fundamentally sound business that you would be proud to own for the long term. This fundamental conviction is your anchor. It's what will give you the strength to hold through normal market volatility later on. Without this step, you're just trading ticker symbols with no understanding of the underlying business, which is a dangerous game. Once you have your watch list of fundamentally sound companies, you resist the urge to buy immediately. This is the hardest part for fundamental investors. Instead, you move to step 2, technical analysis. Now you're asking a different question: is now the right time to buy? You open the chart for your fundamentally strong company and you start your technical due diligence. First, what is the overall trend? Even the best company in the world can be a terrible investment if you buy it in the middle of a severe bear market downtrend. You want to see that the stock is in a long-term uptrend, trading above its key moving averages like the 200-day. Second, you look for a confluence of technical signals that align with your fundamental thesis. You're waiting for the chart to give you a green light. This often means waiting for a pullback. A great company rarely goes on sale in the news, but it frequently goes on sale in the market. You wait for it to dip into a key area of support, which could be a prior resistance level that has flipped to support, a rising trend line, or a key moving average. This patience does two things: it gives you a better entry price, which increases your potential profit, and it drastically reduces your risk because your initial stop loss can be placed just below that support level. The real magic happens when you see a fundamentally strong story being confirmed by the price action. Let's talk about one of the most powerful setups: the earnings breakout pullback. A company reports fantastic earnings, beating estimates and raising future guidance. The fundamental story has just gotten stronger. The stock gaps up massively the next day on huge volume. A pure fundamentalist might chase it here, but a complete analyst waits. They know that after these explosive gaps, the price often pulls back to test the new support level created by the gap. So they wait patiently for a few days or weeks. If the stock pulls back on low volume and finds support at the top of that gap or at a key moving average, and then forms a bullish candlestick like a hammer or a bullish engulfing pattern, that is the technical confirmation aligning with the improved fundamentals. This is the slingshot effect. The fundamental news provided the energy, and the technical pullback coiled the spring for the next leg up. This disciplined approach prevents you from buying the emotional high and instead gets you in on the logical, secondary test. Conversely, this process helps you avoid value traps. These are stocks that look incredibly cheap on a fundamental basis, low P/E ratios, high dividend yields, but the chart is in a relentless downtrend, making lower lows and lower highs. The technicals are telling you that the market knows something you don't. That there is a fundamental flaw not yet apparent in the reports. In this case, the chart is a warning system, telling you to stay away no matter how cheap it looks. By combining both methods, you protect your capital from these hidden pitfalls. Remember, this is educational content and not financial advice. All investments carry risk, and it's crucial to do your own thorough research or consult with a qualified financial advisor. If this framework for becoming a complete analyst gives you a more structured way to approach the markets, please support the channel by liking this video and subscribing for more strategic investing content.